To start off, the average cost for car insurance across the US is about $1,771 according to a Bankrate study. Now, the biggest factor that we've seen as far as a rate change is your insurance score. That's a fancy word for saying credit because it really embodies a few different pieces. And at the end of the video, I'll link another video if you want to learn more about what all entails an insurance score versus what a typical credit score is. They're very similar. If you have a poor credit score versus having a really good credit or insurance score, it can impact you almost $100 a month. On average, it would be a swing of about $1,200 per year that could be added on to the average. So if your $1,700 average policy, that's your typical person that has full coverage on a vehicle, they're doing those 100, 300 coverage, which we'll talk about in a moment, but adding $1,200 onto that is a big increase. You're almost $3,000 a year just to have insurance on your vehicle. The second impact that you're going to see is based on tickets. Commonly that it actually makes a major impact because it doesn't really necessarily put you in an accident. You're not paying a claim. It's just showing that there's a higher risk. Someone that is caught going faster is typically going to be more of a risk to that insurance company. So you're not going to see a major change there. It's anywhere from $20 to $50 a month. So you're going to see an extra $200 to $300 a year if you have just a single speeding ticket. Now, if you double that, we're talking about accidents. So if you have any at-fault accidents, that also can raise up to $600 or $700 per year, more or less, depending on the situation. Commonly, if you get a ticket and an accident in the same occurrence, you're not going to necessarily going to have both of those rated against you. That's one of the benefits is they take the worst of the two. So when I had a claim, I had a failure to yield and I had an at-fault accident. The failure to yield still shows up on my record, but it doesn't count for insurance purpose. The actual at-fault claim that I had counts harder than the ticket. In that case, the ticket shows up, but it's just listed as a not rated occurrence. The part that a lot of people didn't realize, and this was from the past, especially if you're in some of the states like Michigan or California, or some of those other states that had temporarily laws or have laws against having prior insurance. Almost every single state, minus a few of them, rate not having a prior policy against you. If you're new to insurance, you're higher risk. If you let your insurance lapse, if it's due to certain situations, then the rate will go up. It doesn't impact as much as it used to. I used to see where it would go double with some customers, but you're usually seeing a swing of a 10 to 20% difference between having a good insurance policy versus not. More so to piggyback on that, it's not so much the fact of having insurance. There's two other factors to that. It's longevity of having insurance. If you've had insurance for a year or more, 3 years or more, 5 years or more. Those are really those three key pieces that you want to think of. Having prior insurance doesn't just mean you have insurance and you get the discount. Most to almost every single company requires that it's 6 months of prior insurance. It shows that you've been with a company without having any problems. They're going to give you a discount for that situation. More of a discount the longer you've had the policy, up to that 5-year mark, and you've kind of maxed out that discount. Just to put a price behind it, according to Bankrate, you're about $178 a year different between the person that has it and doesn't have it. I would actually caveat that and say it's a little bit more with some companies. They put a little heavier emphasis. Not so much, like I mentioned, not having it, it's the level of insurance you had. So if you have the higher limits and you choose to go lower, you're going to get a temporary discount and vice versa. I've got a video I'll link at the end that goes more into detail exactly what that entails because it's a little bit more than I want to unpack in this video. And we can't leave out the major occurrences. So if you have any type of criminal activity, any drinking while driving, DUIs, things like that, SR22s, those are pieces that are major occurrences that you have to have filings and go through court pieces and whatnot. Those are going to impact your rate quite a bit. You could almost double the policy in some scenarios. Depends on the company again. Some companies rate heavy and not heavy against those situations. So if you have a great situation, you have those occurrences, you're going to have to do a lot of shopping because the company that is giving you the longevity discount for 5 years and you have the higher limit, so you're getting a discount for that. You're combining your home and your auto and all that, but then you get a DUI and a speeding ticket. That almost knocks you completely off of their radar. They're not looking for that type of risk. Their model wasn't built to price that correctly. And when they do come in and that price comes in, that's where a company might give you some ridiculous figure like $13,000 a year. It's their way of saying it's not a fit. They're not the typical client for the right company. So we've got to find the right fit for each person. By the way, if you guys are shopping for insurance, I will put a link in the description below. Feel free to fill it out, and I will try to connect you with either one of the companies that I personally work with or one of the companies that is really good fit in the area that you're in. Caveat to the high risk, we're obviously those that have teens, that's a big subject, especially on YouTube. That's a common thing, is younger drivers do cost more. If you're under 25, that's typically high risk. Anywhere from 25 to 50 is the perfect scenario. 50 to 75 or 74 or something like that is good. And then the high risk goes back at the 74 on up. So let's dive into the real meat and potatoes of what I wanted to talk about, is the way that the industry ranks the cost of car insurance. And this is the actual reason you can look at, which kind of blew my mind that it's changed this much. There's 4 main pieces to a policy. You've got your bodily injury, which is injury to others. You've got your property damage, which is if you damage their property or vehicle, house, whatever you hit. You've got your comprehensive, which is covering your car for other than collision, theft, vandalism, deer, things like that. And then you have your collision. Those are the 4 staples or the foundation of an insurance policy. You can add a whole bunch of other stuff on, like uninsured motorist, and you can add on gap insurance and vanishing deductible. There's just tons of packages that a lot of companies offer, but the staple of insurance was based on those 4 pieces. Those are what the rankings and the ratings are based off. Most of the time, and what I usually tell customers is they don't care so much about your car because they can predict what your car is worth. That's easy. They don't know how much you're going to hurt somebody. The biggest rating factor is the liability limits. If you were to hurt someone and it was a $2 million, $5 million, $100 medical bill, they don't know. So that's the risk. How many people are in the car? That's the scary part of insurance. Your property damage, same scenario. You can't really predict that, but the location that you're in can. That's where location plays a factor. If you're in Miami, they have a lot nicer cars, so you're around a higher possibility property damage versus if you were in Michigan. There's not as many 100,000 plus vehicles in the Michigan location versus in Florida. Yes, there's other pieces like weather and location, snow versus rain and hurricanes. So those all do play a factor as well, but we're just thinking of the actual inflation portion. If you look at the frequency of claims in the last decade, it's common for a comprehensive and a collision claim to be filed. That's the most common piece. A comprehensive claim is 3 times more likely to be filed than a liability claim. And a collision claim is almost 4 times likely to be filed than The whole thing that sparked my interest in this topic and doing the research was from III.org. They actually have a chart that went from 2017 to 2021. And this is where it kind of got me thinking really heavily, because this last year, the states have totaled over $1 trillion worth of claims. So there's a lot of money coming in, but there's way more money going out than they anticipated. But it's not what we think. I always used to tell people that liability was the biggest piece. 2017, 90 billion of it was liability. 2018, 91 billion, 96, 81, and then this year, 96 billion. So 2019 to 2021 were almost identical. But if that's the case, and there's not as many medical claims going out, why is the car insurance getting so expensive and going up every year? Why is everybody touting that they are making profit on homes, because that's just the cost of lumber, versus they aren't making as much profit on the auto because there's too much risk there? 2 things have happened. One, a lot of states like Texas has had what they call a winter storm, or a winter cane as they're calling it. Basically, they had a lot of snowstorms that came through and caused almost actually more damage. I believe it's almost 3 times as much damage as Hurricane Ian did to Florida. Those were unexpected. Ian is semi-expected. Companies plan for that and not this. That's why they call them black swan events, because they're just unknown. You just don't know if you're going to have it. In that case, it doesn't cost more for liability because it's very rare that somebody gets injured in those versus the car getting totaled out. Yes, there is some medical and all of that is a piece of it, but it's not as much as it has been in the past. That's why you see from 2020, it was only 81 billion in medical versus 96 billion. So it was an increase between last year to this year in the medical payout, but it's not much different than the past years. Here's where the kicker came in. 2017, it was 57 billion in auto claims, just property damage. 58 in 2018, 62 in 2019, 54 in 2020, $73 billion. I believe it's billion. It might be million, but I'm 90% sure it's billion. $73 billion were paid out on auto claims. So what's happening, if you read into the articles a little bit more, and I actually pulled up a couple different spaces, is the cost of cars, yes, is more expensive, but a lot of it is the cost of labor. The other pieces is the cost of the whole U.S. as a whole having all of these different events happening. It wasn't just Texas. There were other states like Louisiana had some issues, and different states like North Carolina, and there's all of these different claims that just popped up all of a sudden on top of the cost of materials, the backup of getting materials in, so precious metals are harder to get, but then we didn't have people working as much. There weren't as many mechanics. You go to a shop today just to get a tire patched. I had one of my friends had to wait 3 days because they were just backed up. And when you get backed up, the smart thing to do to try to weed that out, you can either A, add on just tons of work and lose all these customers, or B, you can raise your rates so that it kind of weeds out some of the non-serious businesses or non-serious projects that you have to work on. And that's what we're starting to see now is the cost of labor, the cost of materials, the cost of time, because these companies usually pay rental cars. They're paying for losses of use and different pieces. So the quicker it is, the better the insurance company gets, which is completely different than what it has been in the past, because usually it is the liability portion that is the unknown. Right now, it's the car accidents that is the unknown. Here's the kicker. Not all insurance companies are paying these bills. It's kind of weird because I dug in a little bit further and it was kind of cool to find out that only half of all of the claims being paid are just from insurance. 26% of all claims being paid are just individuals. It usually means that they didn't have the right coverage or enough coverage for the scenario and they went to court or they had to pay out of pocket. That's one of the main reasons you need to have an agent that knows what they're doing, or at least know yourself the coverages that you should carry so that you're properly protected. Link in the description below. Fill it out. 14% were paid by different charities, different organizations, healthcare programs that just gave back to people that couldn't afford it. So if you did have the wrong coverage or didn't have enough or any, then some of the U.S. stepped up and said, here, we're going to help you pay some of these bills, which isn't a lot, but it still helps. And then we got the little things like federal and some of the state and local. I think it was 6% for federal and 3% for state, which I don't even know how that even pays out. I know in Michigan that's a little bit different because we have a fee that you have to pay if you have a certain coverage. So that fee in our case would probably kick out. That's probably where it's coming from, is the few states that have what they call tort or PIP levels, then those are like put into a bucket and they're taken out as need be. So where do we go from here? What's the next steps for the insurance industry and what can we plan for? I can tell you, if we look back in the past from 2010 to 2013, it went up year over year 2%. 3.5%, 3.4%. 2015 was 3%. 2016 was 5%. 2017 was 6.5%. 2018 was 5%. 2019 was only 1% because that was the COVID times. And now 2020 and 2021, we're seeing some companies 15, 20, 30%. I just heard of one that did a 90% rate increase. Clearly, they're weeding out almost all of their business and are on the end of their life cycle as a company. The problem that we're running into is it's becoming more of an issue for those that are purchasing insurance. We're noticing that because of the cost, people are driving uninsured more than they normally do. For example, Florida is right now, as of 2019 and up, at least 20% uninsured motorist. You drive into Mississippi, 30% of that state right now is uninsured. With the rates climbing, especially in states like Louisiana and Florida and Michigan and all of the main states, mainly Texas is a huge one, and Florida, those guys are just seeing just astronomical price increases. It's kind of left us with no other option but to shop. You got to find the companies that aren't hitting those rate increases or aren't having those loss ratios. They're going to be tighter to join because they're going to tighten up their belts and say, we only want specific types of customers. Otherwise, our model is going to fall apart. We don't want to be like these other 20 companies that are going insolvent in our state. We want to be profitable. We want to do it, but we also don't want to have the customer pay an arm and a leg either. Unfortunately, some of the costs and the delays and the things we just talked about are forcing that to become the situation. And that's not to say that the liability portion or what we call bodily injury isn't a factor of this, because if you actually look back from the NAIC, they've stated that from 2008 to 2017, they've seen a 31% increase in bodily injury claims. They've seen a 26% increase in the PIP. So those are both medical in that scenario. That's what I've always known to be the main factor of why the rates are so crazy. And so it's kind of a combination. Even though the claims haven't gone up as much, the cost still has. We're not slowing down. We're still seeing a 2 to 3% increase in autos being insured. So there's more vehicles on the road today than there have been every single year since 2017. So if we add 2% 2017, 2018, 2019, 2020, 2021, you're seeing that there's a lot of stuff. There's a lot of cars. There's a lot of risk. There's a lot of liability. There's a lot of things that are adding to these factors. So I hope all this information was helpful. I had a lot of data I had to share with you. There's just so many ways. Like I said, it's almost come to the point where it's time to shop if you're getting a 15 to 20% rate increase. In states where I'm in, like Michigan, they are going up about 10% across the board that I've seen. You are going to see some increases, not just on the house, but on the car insurance as well. Is it worth it to shop? Hopefully you love your agent and they can reshop you as well. If you don't, there's the link description below where you can fill out that quote online. In the meantime, yes, insurances are a for-profit company. They need to pay their stockholders. They need to make profit. And with the pieces that we just mentioned increasing along with trying to make the profit, a lot of these companies are going to come out and have these large increases that you just can't expect. I'll try to keep up with as many as I can. Subscribe if you guys want to follow some more as the industry changes and as things happen, especially with EV vehicles coming on the road more. There's just a lot to cover. Let me know what your guys' thoughts are if you have questions. Otherwise, if you guys are interested in learning more about the coverages you should carry, I've got my Insurance 101 for the auto. But also, if you want to know more about that insurance versus the credit score, I'll go ahead and link the quick video that I made about what's the difference between the two and then how you can make it work in your favor. I'm Mark with Think Insurance. I'll see you in the next one.